Hey guys, Michelle Kinney here, talking all about options. I'm going to talk a little bit right now about commodities. So sometimes people ask, well, what can I put in my portfolio to hedge? People often misunderstand diversification, right? So sometimes people think diversification is a bunch of different stuff. But you can have a bunch of different stocks and not be very diversified. Really, what it comes down to is correlation. So how related are all of these companies, right? So sometimes people ask, well, how can I hedge my portfolio? I want to add something in my portfolio, so if most of my main stuff is going down, maybe I have something that protects it a little bit. And oftentimes you can use things like commodities to do that. So what are commodities? Commodities could be gold, silver, soybean, corn, wheat, energies, things like that. And you can trade them a few different ways. You can trade individual stocks that are commodities related, or you can trade exchange traded funds like baskets of commodities. In this video, I'm going to walk through some different ideas with you. Before we jump right in, make sure you subscribe. It's in the bottom right hand corner. I'm doing a video each and every single day for 1,000 days, talking all about investing, primarily options, of course, because that's my passion. And that's the best way to make money in my view, because you're creating income on a regular basis. If you're just a stock trader and you're just waiting for your stock to go up, in my view, you're doing it all wrong. Hey guys, so first of all, I'm going to talk about some metals. I'm going to start with Barrick Mining Company. Here's a 1-year chart, and we'll see how gold has gone up significantly lately. So let's take a look at the options. Now, as you know, you get to choose the date. So you can do 1 week, a couple of weeks, a month, a couple of months, and longer, as we can see here. Let's just look at a June 2026 contract. That's about 7 months away. So Barrick Mining is trading at $36.55 per share right now. And let's say we wanted to sell a $30 put. Now remember, a put means that we're committing to buy 100 shares if the stock drops below the strike price before the expiration date. So this contract last traded at $196. So $196 gets dropped into our account right away, and we'll purchase 100 shares at $30 if it goes below $30. Now, I never make a trade without calculating the rate of return because I want to make sure it has a good rate of return for the risk that I'm taking. So I'm going to divide my premium, $196, divided by 3,000, which is the capital needed to make this trade if I'm not using any margin. So I'm making about 6.5% on my money, and I'm holding this contract for about 7 months. So if I divide by 7 and multiply by 12, I want to get my annualized rate of return. I'm making about 11% on my money. Not so bad, and it is pretty far away from where it's trading now. In fact, it has a 22 delta, meaning that it only has approximately 22% likelihood it's going to go below $30 before the expiration of the contract. Now, I want you guys to notice something. If I go lower on the strike price, look at the really wide spread between the bid and the ask. So the bid and the ask represents buyers and sellers. So typically, if I am selling a contract and I put a limit order in at the bid price, there's automatically someone on the other side waiting to purchase that contract. And the lower I go in strike prices, the wider that spread is. Personally, I don't like to trade contracts with really wide spreads because your fills typically can be pretty bad. So you just want to keep that in mind. Let's look at a shorter term contract for Barrick. Let's look at December 5th. November 28th is going to be a short week because of Thanksgiving, so we'll just look at December 5. Now let's say I wanted to go with a 34 delta as an example. That's a $35 strike price. And again, this is a very wide spread. $21 bid and $243 ask. If I was to put an order in on a contract like this, I would enter a limit order somewhere around the last price, a little bit higher or a little bit lower. Now, you definitely don't ever want to enter a market order when you see a very wide spread, because that could mean you'd get the lowest fill possible, and you don't want that to happen. So that's a company that represents gold. Let's take a look at silver. SLV is the iShares Silver Exchange Traded Fund. So the chart is pretty similar. It's definitely been in an uptrend most of the year. And right now, SLV is trading at $45.30. So first, we'll look at a June contract, like we did with gold. And let's say we want it to be pretty conservative, pretty far away from where it's trading now, Let's start looking at a 20 delta, meaning that there's a 20% likelihood that the price would drop below $38.50 before the expiration date in June of 2026. So the bid on this contract is $139, meaning $139 gets dropped into your account right away, and you're committing to buy 100 shares of SLV if it drops below $38.50 before June 18, 2026. Now let's check the rate of return. We're going to divide $139 into $38.50, which is the amount of capital we'd have to put up to make the trade if we're not using any margin. So that means we're making about 3.5%. So again, this is about 7 months. So we're going to divide by 7 and multiply by 12 to get our annualized rate of return. So we're making about 6% on our money. Not that much, but a trade like this is meant to hedge your portfolio, so you don't have as much volatility on your net asset value if you have a lot of tickers that decline in price. Another thing that you can notice about SLV is it has expirations every couple of days. So you'll see November 24th, November 26th, November 28th, December 1, December 3, December 5. Many stocks that we review and most stocks that we trade typically expire every Friday, but this particular ticker has 3 contracts per week. Now let's take a look at a broad-based commodity index like DBC. DBC is Invesco ETF, and it's a broad-based commodity, and it has things like gasoline, crude oil, gold, natural gas, soybeans listed right here on their website. Now, the first thing that you'll notice if we look at the options chain for DBC is that we don't see weekly options. So for this particular contract, we see December 19th, January 16th, then April, then July. So it's not traded as frequently as other contracts. So let's take a look at December 19th. And right now, DBC is trading at $22.53. Now, if we look at a $22 put or a $21 put, we notice something similar as to what we saw previously. The bid is 0 and the ask is $480. Very, very wide bids to ask spread. So again, you definitely would never put a market order in on a contract like this. Let's look at a different commodity ETF. GSG is the iShares commodity broad-based ETF. So we're going to look at the chart, very choppy, and then let's take a look at the options. So GSG is very similar to DBC in the sense that we only see these monthly contracts here. But let's take a look at the spread between the bid and the ask. We'll start by looking at a December 19th contract. Now this particular ticker is trading at $22.77. Now we see a little bit closer spreads. So for example, a $22 put that expires in December has a $10 bid and a $25 ask. I probably wouldn't trade any options on these broad-based indexes because they're not traded that much and they can be harder to get in and out of with a good price. Let's look at an energy type company like ExxonMobil. The ticker is XOM. So first we'll pull up a chart and we'll see very choppy. Down, up, etc. And right now it's trading at $117 per share. Now, if we look at a December 5 contract, again, next week is Thanksgiving, so we won't look at that week because it's a short week. Let's say we went with a 33 delta, meaning a 33% likelihood that the stock is going to drop below the strike price of $115 before the contract expires on December 5th. It last traded at 106. Let's take a look and see what our rate of return would be. We're going to divide $106 into 11,500 because that's the capital we have to put up in order to make this trade. And we're making a little bit less than 1% for about 2 weeks, but next week is a short week. So if we annualize that out, we're making about 23% on our money. And the reason why the rate of return seems to be a bit low is because the implied volatility is a bit low. Remember, the implied volatility is how much swing a particular investment has, how much it goes up and how much it goes down. And typically an implied volatility of about 22% is very, very slow and steady, you might say. Let's take a look at one other energy type company. Let's look at Energy Transfer Partners. The ticker on it is ET. Now, one thing that we notice with Energy Transfer is that it pays a quarterly dividend. We can see that when we hover over the dollar sign here on the chart. So dividends are kind of cool because if and when you have to buy the shares and you hold on to them for a period of time, you're getting paid a little bit of cash along the way. Let's take a look at the options chain. So this stock is trading at $16.51. And let's take a look at a December 5 contract. Now the implied volatility is pretty low for this as well. In fact, let's say if we sold a $16 put, it has a 21 delta, and the bid is only $4 with an ask of $12 and a last trade of $8. Let's go out a little ways. Let's say we went till the end of the year, December 26th, and we wanted to sell a put on this, a $16 put as an example. It last traded at $17. So we're going to divide $17 into the capital required to make the trade, which in this case is $1,600. And that's giving us a rate of return of a little bit more than 1%. And we're holding this for about 4 weeks. So if we multiply this by 12, we're getting an annualized rate of return of about 12%. Now, one thing that you want to keep in mind, with some investments, you'll get a K1. What that means is this: Energy Transfer is a limited partnership. So you'll get a special tax form at the end of the year. It doesn't make it bad or anything. You just have to be aware of it. That way you can include that when you do your taxes. And also, K1s are generally processed late. So anytime you invest in anything that produces a K1, generally you're not going to file your taxes by April 15th, but you'd file an extension and file by October 15th. So just something that you want to be aware of. Let's take a look at one other stock, AWK, which is American Water Works. Right now it's trading at $132 per share. And we'll notice by the dollar signs here that this stock also pays a quarterly dividend, which is kind of cool. Now, they don't offer weekly options, so we can see in the list here December 19th, January, March, and June. Let's just take a look at the March 2026 contracts. Let's say we wanted to sell a 29 delta. The strike price is $125, so we're committing to buy 100 shares at $125 per share if the price of the stock drops below $125 before it expires. Let's take a look and see how our rate of return looks. This contract has a 330 bid, a 410 ask. It last traded at 550. But if it opens close to where it closed, we won't be able to get 550 because the ask is much lower. Let's just estimate that we would get $350 on this contract. It's a pretty good estimation. So if we're making $350 in premium and we're putting up $12,500 to make the trade, assuming no margin, that's almost 3%. And we're holding the contract about 4 months. So we're going to divide by 4 and multiply by 12. We're getting an annualized rate of return of about 8%. Again, the return is a bit low because our implied volatility is low. Are you guys starting to see the correlation between some of these things? And last but not least, let's just do a Bitcoin trade. So IBIT is a Bitcoin ETF. And right now, Bitcoin is super down. And we'll see IBIT is $47.97 per share. And let's say I want to go a little bit further out on this particular trade. Let's say I want to go out about a year. We can look at an October 2026 contract. I'm just giving you different ideas, different dates, different tickers for you to take a look at and see what might be of interest to you. Now, sometimes I like to go far out on stocks that have come down a lot in price, like this one. So let's say I want to sell a $40 put. I'm committing to buy 100 shares at $40, but only if it drops below 40 before the contract expires. And the delta on this is only 25. So it's more likely that it will stay above $40, requiring us to not have to buy the shares. $524. And we'd be putting up $4,000. Let's take a look at our rate of return. $524 divided by $4,000. That gives us a rate of return of about 13%. And we're holding this contract for a little less than 1 year. And this can be a great alternative to actually holding Bitcoin. Because remember, when we trade Bitcoin, we don't actually make any money unless we sell our coin, just like stocks. But when we trade options, we put cash in our pocket on a regular basis. Much, much, much better. So how'd you like that video? Was it helpful? If you liked the video, smash the like button. Be sure to subscribe to my channel. I'm putting up a video every single day for 1,000 days. Say hi to Franklin. Happy trading.